So what if you could control a massive position in a world-class company, but for just a tiny fraction of the cost? Well, today, we're going to break down a really smart, capital-efficient strategy for investing in what some people call a compounding machine. Okay, let's dive right in.
Just look at this. If you wanted to buy 5,000 shares of a company like Kimberly-Clark, you'd need, well, over $500,000. But what if I told you there's a way to control those exact same 5,000 shares to get all their potential upside for only about $5,000? That huge difference is exactly what this strategy is all about. So, the big question is, how on earth is this possible? Well, here's how we're going to break it down. We're going to look at the anatomy of the trade itself, explore the bull case for the stock. Then, and this is the interesting part, we'll look at why the quote-unquote worst case is actually part of the plan. And finally, of course, we'll weigh all the trade-offs. All right, first up, let's get into the actual mechanics. The engine driving this whole strategy is something called a risk reversal. Now, I know, it sounds a little complex, but it's actually a pretty elegant concept once you see how all the pieces fit together. So, what is a risk reversal? The easiest way to think about it is in two parts. First, you're buying something called a call option. This is basically your ticket to the upside. It gives you the right to buy a stock at a set price in the future. Then, to pay for that ticket, you sell something called a put option. This is a promise that you'll buy the stock if its price falls to a lower predetermined level. And the real magic here is that you structure it so the net cost to you is incredibly low, sometimes even zero. Okay, so let's make this real. For Kimberly-Clark, or KMB, it's a simple two-step move. Step 1. You buy a call option that gives you the right to purchase the stock at $115 a share. Step 2. You sell a put option, which means you agree to buy the stock at $100 if it ever drops that low. And you'll notice, both of these options expire way out in March 2026, which gives this whole idea plenty of time to play out. You know, there's a really great analogy for this. Think of it like you're putting a small, non-refundable deposit on a house you think is going to go up in value, but you're funding that deposit by making a promise to someone else. The promise is that if the housing market completely crashes, you will happily buy that exact same house from them at a huge discount. See, you either get the upside or you get to buy a fantastic asset on sale. So by March of 2026, there are really only three ways this can go. Scenario 1, the stock is above $115. You win. You capture all of the upside from there. Scenario 2, the stock is somewhere between $100 and $115. The options just expire and all you've lost is the small premium you paid to get in. And Scenario 3, the stock is below $100. In that case, you are obligated to buy the shares at $100, which, as we're about to see, is a key part of this whole strategy. Okay, let's talk about the bull case. Why would we even bet on the stock hitting $115 in the first place? Well, it turns out there's some really powerful catalysts on the horizon for this company. There are a few key things working in our favor here. First, the company's in the middle of this massive restructuring, aimed at saving around $3 billion. That's a huge boost to the bottom line. Second, that crazy inflation we saw in their raw materials is finally starting to cool off, which should directly help their profit margins. And what's really interesting is that our target of $115 is actually pretty conservative. A lot of Wall Street analysts have price targets closer to $130, even $140. And by using these long-term options, we're giving this whole positive story nearly 2 years to come true.
But what if we're wrong, right? What about the downside? This is where the strategy gets really clever. The so-called worst-case scenario isn't a failure. It's actually a planned acquisition of a great company at a great price.
This quote from the source material just sums it up perfectly. The absolute worst thing that can happen in this trade is that you are forced to buy a blue-chip, dividend aristocrat company at a price you already decided was a deep discount. It's a strategic entry point, not a mistake. And just so we're all on the same page, what exactly is a dividend aristocrat? It's like a badge of honor in the investing world. It means a company has increased its dividend payout to its shareholders for over half a century. Kimberly-Clark has done it for 53 years straight. It's just a powerful signal of financial strength and incredible stability. So why is $100 the magic number? Well, for a few reasons. Historically, the stock has found a ton of buying support right at this level. At that price, the valuation becomes really attractive, around 15 times earnings. But the biggest factor is the dividend. Because at $100 a share, Kimberly-Clark's dividend yield skyrockets to over 5%. And let me tell you, for a company this stable, a 5% yield is almost irresistible to big money, income-focused investors. It acts like a powerful magnet, drawing in buyers and creating a natural floor for the stock price. Now this all sounds pretty fantastic, but no strategy is a free lunch, right? It's really crucial to understand the trade-offs and the risks that you're taking on.
There are two main risks to think about. The first is opportunity cost. If the stock just goes sideways and doesn't move much, your options will expire worthless, you'll lose your small premium, and you won't have collected any dividends like you would have had if you just owned the shares. The second is the margin requirement. Because you promised to buy the stock at $100, your broker needs to know you have the funds. So they'll require you to set aside capital in your account, that's your margin, which is basically collateral to back up your promise.
But when you step back and look at the whole picture, what you're left with is this beautifully asymmetric bet. Your maximum risk is defined, and it's small. It's that $1 per share premium you paid to get into the trade. Your potential reward, on the other hand, is theoretically unlimited. The higher the stock goes, the more you make.
And that really leaves us with a final thought to chew on. This whole strategy forces you to ask a pretty fundamental question. In investing, what's the bigger risk? Is it simply losing a small amount of money? Or is it being right about a company's future, but having no plan in place to actually capitalize on it?